Welcome back to another episode of ACM Invest Ed. I'm Mark Armbruster, and today we're diving into election season. As you're aware, 2024 is an election year for the U.S., but it's not just the U.S. taking center stage. We've got numerous global showdowns with elections in over 60 countries. That includes India and the European Union, both with larger populations than the U.S., making 2024 the most active election year ever, with over half of the world's population getting ready to cast their votes. So today we're tackling the question we're asked every election cycle. Should you adjust your investment strategy based on the upcoming vote? Election season can cause investor anxiety, and it's certainly natural to worry about how it might affect your investments. But here's the bottom line. History shows us that timing the market based on elections, or really any other factor for that matter, usually results in disappointment. So let's dive into the data. Since the Roaring '20s, the S&P 500 has largely ignored the game of politics for the most part. In fact, since 1928, 20 of the last 24 election years, the S&P 500 has provided positive returns, irrespective of which party won the election. While there may be some short-term volatility around elections, election years haven't really shown a significant impact on long-term market performance. And the losses for the 4 periods with down markets are likely attributable to more extreme external factors, such as the Great Depression, World War II, the dot-com bust, and the global financial crisis. There is evidence that election years can be more volatile than normal, but that short-term volatility corrects pretty quickly. There's also the presidential election cycle theory, suggesting a predictable market pattern based on the 4-year term. According to this theory, the first 2 years of a president's term tend to see lower returns, followed by stronger performance in the 3rd and 4th years. However, over the last 40 years, the data shows the theory to be true only about half the time. Investors as a whole are more interested in the health of the economy, corporate profits, interest rates, and other global events than who's in the Oval Office. So, trying to predict the election winner and the impact they will have on the market is a gamble best left to Las Vegas, not your retirement assets. It seems logical that politics would have a larger impact on the economy and stock market returns. After all, proposed changes to taxes, healthcare, and trade can all influence investor sentiment and market dynamics. However, that just doesn't show up in the data. I remember when Barack Obama was elected president and many of our Republican clients got upset. They figured Obama was a relative novice politically and economically, and he could ultimately lead us into a recession. However, the stock market mostly went up under Obama's term. When Donald Trump was elected, our Democrat clients were concerned that he was unstable and he would get us into a war that could upset the global and economic balance. However, the economy grew, and the stock market generally rose during Trump's tenure. Finally, our Republican friends were again alarmed when Joe Biden was elected. He was too old and too leftist, which would hurt us economically. You can quibble about the state of the economy today, but the stock market has recently been making new all-time highs. So, as emotional as elections can be, it's best not to mix your politics with your portfolio. Don't let your emotions ruin a solid long-term plan. Patience is key, and building wealth takes years of discipline. Focus on your long-term financial goals, stay the course, and don't get bothered by short-term market ups and downs. The market has consistently trended upwards with remarkably few nasty downturns. The power of long-term compounding is your friend as long as you let it work its magic. So thank you for watching this ACM Invest Ed episode. Check out our other videos on our YouTube channel, and please leave us your thoughts and suggestions in the comments below.